20%, which is about the highest in the industry. And as a result of that, impairment charges has been rising and has constrained profitability. Another important pressure point on FBN's bottom line is operating expenses. Because it's a very large group, they tend to have very high OPEX, compared to its peers in the industry. As a result of that, the earnings performance of SBN has been underwhelming in the last 2 or 3 years. And further to that as well, they've also been facing capital adequacy ratio pressures. Out of the 6 Tier 1 banks that we cover, FBN has the lowest capital adequacy ratio of about 17.5% as of 9 months 2017. So, and due to the weak capital adequacy ratio, dividend payout has been constrained. So if you take into consideration all these factors that I've mentioned, you will see the reason why the bank is being valued at such a low multiple compared to its peers. However, despite these changes I've mentioned, we still have a mildly positive outlook for FBN, on the back of what we expect, as we expect the bank to now record lower impairment charges going forward, because economics exists in cycle. So we have seen a very poor, economic cycle from 2014 to 2017. However, we're beginning to see the economic fundamentals improving. As a result of that, we should see asset quality metrics for FBN also improve, consequently.
Let's get on. First, quickly, bring on Skype Olufemi Awoyemi, who is a financial analyst and the CEO at Proshare, Nigeria. Femi, good morning. It's good to have you.
Good morning, Boason.
Yes, I can see, and everyone can see the archival records behind you. So it's so I'm sure you got all the market memorandum, the bull in the China shop, and everything else in the last 10 years locked down there behind you. So I'm sure you've been taking time all night to go through the last 10 years.
Yeah, sure I do.
Yes.
I do.
Okay.
And,
I'm sure we're going to get to that in a moment. Just a second. With the discussion with Omotola Abimbola here is about 2 of Nigerian banks. Of course, the big elephant is the FBN Holdings. Then Diamond Bank is also in the news this morning. So we're asking some of the questions. What's your take on First Bank?
Well, First Bank, because of its size, because of its dominant position in terms of account numbers, assets, balance sheet size, seem to have took the huge brunt some of the challenges you had with exposure to risk areas, which he had, which surprisingly for me, it confronted wholeheartedly. And that is why you see what Exotic has said is quite interesting. And I saw what Taiwo also sent out from Stockman, which shows you that share prices are recovering. The fundamental challenge had always been with the NPL position. But what they've done is a very bold attempt to try to confront the big problem. What some of us in the analyst market think would be a 8-year, 9-year problem, they're beginning to dial it back and seemingly on a path in which they can begin to claw back the returns on assets, which had become a major issue. But significantly, what is happening in First Bank, from the knowledge we have, is far much more than dealing with NPLs. I think there is a bigger secret in the market that they are actually recalibrating the market to work both with its size and scope and turn all its negatives into advantages for it. And I'm sure by 2008, some of those things will begin to come out in the market.
So I'm going to get at some of the things you said. Omotola, what's you folks issued a report.
Correct.
And First Bank is in that report, as well as Diamond Bank. We need to spend time very quickly to be able to speak about Diamond a little bit. What's your take on First Bank as far as Afrinvest report is concerned?
Yeah, we're actually mildly positive on the outlook for First Bank regarding its earnings. We expect the impairment charges to peak in 2017, and we begin to see an improvement in bottom line going into 2018. Additionally, the management has been trying to restructure some of its loan book. As of half year 2017, they've restructured about 8% of the total loan book, particularly those exposed to the oil and gas sector. So that's very positive for earnings going forward. And regarding capital adequacy ratio, we're beginning to see the numbers, begin to improve, due to the better than expected earnings they are delivering. So we actually have a buy rating on First Bank, for a 12-month holding period.
Buy rating recommendation for that supports, that's in line with Exotic Capital, which also has a buy recommendation. Femi, yes, we got a buy rating recommendation from Exotic Capital. Afrinvest is also giving a buy rating. You don't do rating, but from your professional and analyst point of view, what's your rating?
The key for us is measuring indices that impact on target price. And from all we have done, we see that there is a significant consistency in improvements quarter on quarter in the transformation plans which the First Bank management has put in place. And surprisingly, they're consistent in terms of meeting up on all those numbers. So we see an upward trajectory, and as such, we believe that the trading price will go up. Hence, the buy recommendation by most analysts in the market.
Fantastic. Let's leave that there, folks, and let's go to Diamond. Do you think Diamond is still a diamond in the rough, or there's a rough time here for this lender?
Well, we have to be quite understanding with Diamond Bank. They have some peculiar, what you call peculiar situation. But shrinking the operations from Africa is not necessarily a sign of progress or a sign of strength. But that said, it also means that they have an approach which perhaps is best known to them and not well communicated yet in terms of how they want to make up the numbers, given where the business volume is. They've been suffering a lot of loss, so it's prudent on the part of the management to try to bring everything back while they do some house cleaning. And so for the time being, we're still on a wait and see.
This is what, and this is both Omotola and Olufemi, this is what Diamond Bank said. I'm sure you've read this statement, but again, just to say it's poised to capitalize on the positive macro fundamentals inherent in the Nigerian market, and this includes Africa's largest economy and evolving socio-economic trends given by changing lifestyle preferences in favor of mobile-delivered services and a culture of innovation and entrepreneurship. Femi, I'm going to come back to you very quickly on this first. What's your take on this statement by Diamond Bank as to the rationale for coming back home? Okay, I got. Femi Awoyemi, are you still there?
Yeah, I thought you were going to come back to me. My take on it is that they seem to have a different interpretation of the market prognosis than most of us. Well, we'll give it to them that they do have an interest in the mobile market. And I think they are trying to move in anticipation of what the regulators will do, given that the regulators are still unclear as to the scope, the size, and to the extent to which players would operate within the market. It seems also that they have a strong, they are laying out their bet on a very, very short case. But that is a function of when and how the central bank really moves to allow them to maximize the opportunities and advantages they see. So what we would worry about is what happens in the integral while all these movements are taking place.
Okay, a quick one. Omotola, do you think Diamond Bank wants to leverage fintech or is sniffing around for these digital mobile money services that is likely to come? The bank currently has about 7 million customers in Nigeria. Is this what it speaks to?
Well, for Diamond, they actually have a retail focus in Nigeria. They like to play in the retail segment, and as a result of that, they were exposed to the economic downturn that Nigeria witnessed in the past 3 or 4 years. So we saw NPL ratio rising above 10% as of 9 months 2017, and that has been impacting on their bottom line as well. However, the plans to actually divest from their West African subsidiaries is a way to capitalize their business in Nigeria, because if you look at their full year 2016 reports, their capital adequacy ratio was actually at a regulatory minimum of 15%, and as of half it's improved madly to 15.4%. So clearly they were facing capital constraints, and the only way to get out of that is One, either to raise more capital in Nigeria, by either doing a Tier 2 capital raising, maybe an Eurobond issuance, or do a public offer or a rights issue in Nigeria, or rather to divest from some of their non-Nigerian subsidiaries, to find more capital to support their operation in Nigeria. So they took the alternative option, which is divesting. And it's not so surprising because if you look at the trajectory we are seeing in the Tier 2 segment, about 2 Tier 2 banks have come out to divest, with plans to divest their African subsidiaries. Keystone Bank did this first. They sold down on some of their stakes. Skybank has also come out to say that they will be selling down on some of their subsidiaries in West Africa, like in Guinea and Sierra Leone, to capitalize their business in Nigeria. So clearly, we are seeing the pattern in the Tier 2 segment, where banks who are not, so profitable outside Nigeria are coming back to say, no, why don't we just divest and get enough capital to play in a very large retail market such as Nigeria?
Okay. Femi Awoyemi, let's come to you. 2004, and we're talking about the market right now, if you're trying to reinvent the market. The banks were the big boys, and have always been the big boys. So let's go back to 2004, 2005, bank consolidation. Do you think consolidation, that momentum that we got in 2004 before the meltdown, talk us through this if you're looking at the banking sector right now?
What exactly is it you want to know? Because if you look at the market segments, the market outlook at the time we did the consolidation, it was about the most meaningful strategy we could employ in bringing about by building stronger banks who can actually engage the market, offer the credits which were needed for the real sector, but most importantly, provide financially stable banks. But if you look at that, despite the fact that we went through repeated cycles of capital raising, the major challenge the banks suffered was not anything to do with the economic conditions as you had it in Nigeria. It was basically more professional misadventures that we have. If you're looking at what we currently have today, you will find that the banks have come of age in terms of how they've been able to expand outside the shores of Nigeria, especially the Tier 1 banks. And to my friend's comments about Diamond Bank strategy, comparing them with Keystone and Skybank may not actually be so far from the truth, because it actually shows the conditions of these banks. But a quick one concerning Diamond Bank. You do know that Diamond Bank has been able to cultivate about 15 million customers. So what these banks are basically doing is like, look, we might have overstretched ourselves. We do not have the resources in place to actually play these markets in a more efficient way. Maybe if we consider the use of technology and we consider building up our base in Nigeria with our customer spread and deliberately trying to garner low-cost funds, we can actually strategically adjust our books. That is not a bad idea, but it's not something that's going to be a significant push for an upward trajectory for those banks in the next 2 to 3 years. There is a lot more that needs to be done because the games have actually changed. The macro environment has changed. The sectors where funds are coming from have changed. The ability for banks to be financially much more stable, have access to deposit mobilization far much more. It's getting much more tougher.
When we look at the stock market, we call it the golden age, was before 2008, and then we've seen that momentum went into a meltdown. What do you think the last 10 years had been specifically for you looking back?
Well, first I would say what we call the golden age for the capital market then was masking a lot of underlining, challenges for the markets. Number one, which was corporate governance, So we saw companies, which were coming out to the market to raise capital, but without the right corporate governance and without the right, earnings fundamental. And then the pricing of securities then as well, it was a bit, overvalued, So it was a golden age, but then it was masking larger issues. And what I would say is that in the last 10 years, regulators and policymakers, they've been able to, try to make policies that would take care of some of these, bigger challenges, facing the capital market, such as corporate governance, which led to the crisis that we saw in 2008. So the market has come of age, definitely. We're now seeing much more sensible valuation by analysts in the market today. And we are seeing companies, much more forthright in ensuring that they have the right corporate governance structure.
Let's bring Olufemi Awoyemi from Proshare into this conversation. Femi, 10 years ago or thereabouts, when the market melted down, it was the leadership of the market that was in question. I remember the market memorandum just before the bull in the China shop report from Proshare. So, talk us back through that. Do you think we've been able to address some of these rules and regulation and leadership issues at the marketplace over the past decade?
Well, to start with, Omotola is precisely correct. It was in the golden age. It was a situation in which I felt that was a period in which you had a combination of regulatory inertia, malfeasance, and basically everybody just throwing all caution to the wind. And it was a period of financial exuberance. And as such, we naturally fell to the bubble, which were all jointly created by every one of us. And as you can see, we're not the only ones anyway. And globally, you will see that in terms of activities generally, everybody seems to have recovered, but not entirely to pre-crisis peak levels, especially for us in Nigeria here, where we haven't gotten to. So what is it that we have done? What are the lessons we have learned from all this is that the same situation where we got into, whereby regulation it's not tackling tomorrow's trends, but focused on today's headlines, is still the norm. And as such, you haven't significantly seen any shift in the understanding of how capital formation takes place in the macroeconomy is such that we can bring into our market. The capital market, quote unquote, in a plural sense, has expanded, especially with what is happening with the FMDQ market. But the equities market has basically not significantly changed much. If at all anything, its loss is to retail fervor, a retail market which was not significantly there before. It was just a blip, but it was never really grown. And as such, we have a situation whereby what we ought to have taken from that financial crisis was the opportunity to put regulations, laws, and rules in place that allow for the new market, which we see operating currently, to emerge, i.e. things like crowdfunding, the development of collective investment schemes in such a way that they recognize risk as well, the development of things like the private equity sector, which has a better role in capital formation, and venture capitalists as well. And as such, you begin to see the fixation on looking for public offers, IPOs from companies. Whereas if you look at the macroeconomy, which predominantly service, you haven't found new companies, which, if you look at the macroeconomic framework, the GDP, as you may find, you find that you have growth in telecoms, you have growth in the arts and creative industry. But those are not sectors in which we've been able to find a way to create a financial model for which we can bring into the capital market. So we have learned a few lessons in the sense that the Nigerian Stock Exchange has similarly understood the place of data. We have developed a more robust market analysis system that is not focused on the buy side only. There's also the sell side market. We've also developed instruments which basically help to deepen the market. But we're a far cry from being able to say that we have actually made any quantum leap from the challenge we've had. We still have corporate governance issues, maybe not at the scale at which we had it then, but at a much more sophisticated scale right now. And for me, I think that the major challenge is having to understand that we should create a nexus between the macroeconomy with the markets by readjusting the body of laws that seem to hold us down. You see developments in Kenya, in South Africa, from the Securities and Exchange Commission, from the stock exchanges, in terms of fintech, in terms of listing new tech companies, and we haven't been able to put ourselves in a position where we are able to do that.
You're speaking, Femi, to macro economy making the markets. In the last 10 years, or even before, when the market momentum was there, do you think we have a macro economy that supports the broad street, broadly speaking, whether it's the fixed income side or mutual funds, as you talk about it, or PE, to create new economy and let the market absorb these ones and bring them in for listing or diversifying investors' portfolio and interest and money making?
Okay. No, it's not as complicated as that. The simple fact is this: if you look at the structure of the Nigerian economy, we basically have a balance sheet that focuses more on trade and exports, the more volatile side of it, generating FX, cash flows, financial services system that is structured around mostly governments and corporates. That you do not have mobilization of cash from the retail end because you have a poor insurance, pensions market, all this while. So the markets really reflect capital formation. We've tried, in as much as we want to diversify the revenue sources of government, but we also need to diversify the economic structure to move towards capital flows, i.e. foreign direct investment flows, remittances, and basically the retail end of it, which is insurances, pensions, and what have you. It is when you have such that you have a basis for you to have expectations around your equities market. I feel that the nexus between the macroeconomy has been in some ways a limitation, but most importantly, I haven't felt we've gotten our politics right in terms of how we, at the capital market, manage conversations with the government in terms of the issues they do. Every one of us know fully well the story around Safaricom and how the markets insisted that for any listing would take place. We're hearing some positive news in terms of possible a telecom listing. It shouldn't be a function of a single telecom trying to list. It must really be about us having a very broad base plan, which I think would happen. I mean, if you take simple issues around the market demutualization issue, which seems to be a protracted issue, a matter which we haven't been able to resolve, it is until you have that kind of thing take place, then the markets start beginning to earn a position which they want to challenge and discuss and engage with the government in terms of how they will grow the market. So the capital market has grown because basically we've grown the domestic bond market, we've grown a state government, the corporate CPs market has grown, but the equities market is almost at same levels. In terms of growth.
Interesting, Femi. Omotola, we've seen the last 10 years, 2008, 2017, and of course, everyone knows that the equities market, once the poster boy of the Nigerian securities market, don't seem to be the poster boy anymore. So, do you think we have some reinvention? We've had some innovation. You think we've had some strategic direction? But the equities markets need a new community of investors, a new community of products and offerings. What's your view 10 years down the line, giving us a kind of an insight into what you think we should be doing moving forward?
First, I think I want to agree with Femi's analysis. If you look at the debt market, it has grown quite a lot since 2008, thanks to the efforts of the FMDQ, as well as the deeper market, as well as the federal government of Nigeria, which has relied more on domestic funding of fiscal deficits. Then the subnationals as well, they've come to the market to issue bonds. And even our commercial banks, they have developed more technical ability to trade in more complex financial products such as interest rate swaps, derivatives, etc. But for the equity markets, we've not had the same story. And regarding what Femi said, the major factor holding back the equity market has been macroeconomic stability. Because the economy is still, because the equity market still depends a lot on foreign portfolio investors. So anytime we are having an oil cycle downturn or an upturn, it has a consequential impact on the equity market. Compared that to the debt market, where we have lots of domestic, pension funds and insurance companies who are the major players in the market. So I think for the equity markets, they must also think of a way to adopt the same strategy to have a deeper pool of domestic investors who can pick up these securities, and as such, reduce the impact of volatility in the oil market on equity market performance. Similar to that, we need to encourage more listings as well by corporates, and that could only be done if we make the environment a bit more conducive for them. Since the 2008 financial crisis, the primary market has cooled. We've seen very few primary market issuance. You know, in terms of IPOs, we've seen more of rights issues and, you know, a couple of public offers. So, in terms of macroeconomic stability, the federal government has to do more, and the central bank as well, to improve the environment such that we don't have, you know, so much of volatility in the economy. Then secondly, we need a bigger pool of domestic investors, you know, buying equity securities. And thirdly, we need to encourage more listings in the equity markets.
Femi, you mentioned a few things. You mentioned private equity, venture capital. Do you think we should be getting ready from the regulatory side of things for cryptocurrencies, Bitcoin, startups, what have you, to have a brand new set of investors who are young, dynamic, and good to go? Do you think we also need to have new regulations around an incubation for the, some companies that are coming up? What sectors do you think we will find them and that we should grab them as quickly as possible, reinventing this market?
So here's a simple analysis. Most of the times your capital markets reflects your economy. So if you take the sectors within your GDP as you're broken down to about 36 sectors, and you look at your 12 sectors in your capital market, you want to draw a nexus between those growth areas of the economy and those companies coming up. If you take a simple analysis of companies that have, they were top in 2008, almost 10 years ago, August 9 to date, and you look at companies that are top in the US market and the Dow Jones specifically, with the FTSE, with the CAC, with the Kenya Stock Exchange, with the Johannesburg Stock Exchange, and with the Nigerian Stock Exchange, you will find out that you basically still have almost the same set of companies in the Nigerian Stock Exchange still at the top in there, which tells you that there is basically no nexus between your economy and your market. Because what has happened in most of these economies is there's been a significant shift. For factor-driven economies like Nigeria, which relies on oil and on skilled labor, you will find that that situation should be expected. But if you were to compare Nigeria within the emerging economies that is comparable to itself, you will find out that one of the few things they've done is that there are new businesses which align with the new new market opportunities, basically in technology, within the whole value chain of technology, specifically fintech, in areas of creative arts, where you find places like India doing as well, where you find places like, I think India specifically comes to mind, and Kenya tries, but it's not yet there. So the question is this. I do believe the Nigerian Stock Exchange is already thinking in some way around this area. Through the FinTech Association, I learned that there is a talk around trying to find a small group of people who can be put around the legal table, but not necessarily listed, but in such ways that they can qualify them in terms of corporate governance, in terms of structure, in terms of ability for them to be able to attract the funding they require to take them to the next level. Don't forget that Nigeria, with all the interest in technology, is still is at the consuming end of the value chain. There are no leading products, there are no leading providers, there are no leading solution providers. And with all the talk around innovation, around fintech, you find generic me-too products. So there's quite a number of work to be done in that space. And we're hoping that, I'm not going to hold government accountable for this, I'll just hold ourselves responsible, that the market needs to make a better case to invest a little bit more in research and make a better case for government to show the economic value of, for example, holding us down in terms of making a decision around how we want to approach blockchain, for example.
What do you think is the biggest news for you this week we should focus on? Is it the budget? Is it the BVN battle? Or what is it? Is it the Diamond Bank conference call? What are you looking for?
I'm looking at budget and I'm looking at oil prices.
Oil prices is $62. You shouldn't be looking for any other full price unless you're looking for 100.
Well, the question is, how do our policymakers respond to this, improvements in oil price, and how does the market respond to it? Last week, sentiment was very bullish in the equity market, partly driven by the information, in the global markets regarding oil, and we expect a similar performance this week. Although, what comes of the budget presentation tomorrow by President Muhammadu Buhari could also be a sentiment driver to look out for in the week.
Okay. So Omotola is looking for something in the budget presentation tomorrow at the National Assembly by the President. Olufemi Awoyemi from Proshare, what are you looking for? What are you looking at?
For me, Tola is very correct. There are two things. The budget and oil prices are two key indicators. One, because with the Nigerian oil price, because you begin to see that yield on bonds are dropping, I think 18 point something. From 20, which basically means that the sentiments from rating agencies and analysts and the feedback is that cross-border investors may begin to maybe feeling bearish, even though the sentiments by the governor of Central Bank is very high. The Minister of Finance spoke all the right things. And the reasons are very clear, because any significant drop in oil prices or any decision from the Fed may impact upon the ability for these people. So we are looking at what signaling effects come out from the budget, not so much the numbers, the signaling effect that comes out. But given what is in the MTF, there's not much room to expect a significant change. But it's the tone and the signaling effect that comes, especially because when you have a situation of capital controls, multiple exchange rates, the NAFES trading windows, which only until recently in April began to be stable and we have convergence somehow. Any significant change in oil prices would basically affect all the positives that we've gained so far.
Femi, conclusively, what would you like to hear from the President as far as the budget is concerned, 2018, and perhaps some clarity as far as 2017 budget work in progress?
No, I just need to get a signal that this government will be a little bit more pro-business than it has been up to now.
You're a businessman. That's a nice way to put it. Omotola Abimbola, what would you like to see specifically as far as the budget is presentation tomorrow?
I want to see the President talk about the federal government borrowing plans, as well as issues regarding debt service and burden. How do we put Nigeria ahead of this debt servicing burden that is actually constraining on fiscal balance?
Okay, thank you, Omotola Abimbola. We appreciate your time being here. Olufemi Awoyemi, the Reinventing Market series continues. We didn't have much time today to talk about the market memorandum and the bull in the China shop. You need to dust some of those archival materials behind you up.
We'll do.
You think we need another bull in the China shop?
Yeah, the report will be out soon.
Very interesting. Looking forward. Thank you so much for being here, you gentlemen, and everyone who's been part of the program. This is your Business Morning today, Monday.